The, s- the system that has set the global price of silver for decades is showing cracks. Right now, as I record this, silver is trading at $82.84 on COMEX, and simultaneously, on the Shanghai Futures Exchange, silver is trading at $88.25. That is a $5.41 difference. That is a 6.5% premium. And that gap is not a blip. It is not a data error. It is a signal that something structural is shifting in this market. In about 10 minutes, I'm going to show you exactly why that spread matters, what it is doing to the vaults that underpin the Western pricing system, and what the Asia Open on Sunday night will tell us about whether this is the beginning of a genuine price reset or a temporary dislocation that closes quietly. Stay with me. Last week, I told you to watch the Monday Gold Futures Open as the first read on whether the war premium was holding or starting to compress. Gold opened within $8 of Friday's close, flat, as I flagged as a third scenario, and spent the week consolidating in a tight range. That is exactly what a market does when it is genuinely uncertain about direction. I call it consolidation before a directional move, and that is still where we are on gold. But this week something happened in silver that pulled my attention completely. And that is what this video is about. I am John. 15 years in FX and commodity markets before I ever picked up a camera. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. If this kind of calm, data-first breakdown is what you've been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time because what we are covering today is part of a bigger picture we are building week by week. Here is what we are covering today. What the 6.5% Shanghai premium actually means mechanically, what it is doing to physical silver inventories in the West, why COMEX short sellers are in a position they cannot hold indefinitely, and what you specifically need to watch this weekend. Everything I show you comes from publicly available sources, and I will name everyone as we go. Let me give you the current picture clearly. COMEX silver, the price most of the Western world uses as a benchmark, is sitting at $82.84. COMEX front-month futures are at $84.03. And the Shanghai Futures Exchange silver price is at $88.25. That $5.41 spread between East and West is not normal. A small premium in Shanghai is common. Local taxes, financing costs, market structure. That is normal noise. But 6.5% is not noise. 6.5% is a signal. To put that in terms that make an immediate picture, imagine two petrol stations on the same motorway, 1 mile apart. One is charging 6.5% more than the other for the exact same fuel. Normally, that gap closes fast because drivers will just go to the cheaper one. In silver, the equivalent of that, the arbitrage trade, is physically moving metal from the cheaper Western vaults to the higher-priced Eastern market. And that is exactly what is happening right now. Drop a comment right now. Are you currently holding physical silver, silver ETFs, or mining stocks? And have you noticed premium changes at your local dealer in the past few weeks? The comments section here is a real-time sentiment tracker, and I read every single one. Now, let me explain the mechanics of what the spread is actually doing to the Western system, because this is a part that most channels gloss over, and it is genuinely the most important part of the story. When Shanghai pays 6.5% more for silver than COMEX, it creates an immediate financial incentive for anyone who can access both markets to buy silver in the West and ship it east. That sounds simple. The consequences are not. Every ounce that moves east is an ounce that leaves the registered inventories. The COMEX warehouse system that underpins the paper futures market. The CME warehouse reports are published weekly, and when I pull the most recent figures, registered silver inventory has been under sustained pressure for several months. Now here is where it gets important. The COMEX futures market operates on the assumption that there is sufficient physical metal in registered vaults to back the paper contracts if anyone demands delivery. When that physical buffer shrinks, and a 6.5% premium is one of the most powerful forces that shrinks it, the whole system becomes more fragile. Think of it like a bank that keeps a fraction of deposits in actual cash. Most of the time, nobody asks for their cash all at once, and the system works perfectly. But if enough people ask at the same time, The fraction is not enough. The COMEX is not going to fail tomorrow. I am not saying that. But the registered inventory cushion is thinner than it has been in years, and a 6.5% Asian premium is actively making it thinner every single week. Here is the number that stopped me cold when I looked at the institutional positioning data this week. Short interest in silver futures. The professional traders who are betting on the price going down has been declining. And the reason is straightforward once you understand the mechanics. Maintaining a short position in silver futures when the physical market is trading 6.5% above you is expensive. You are essentially swimming against the current. Every day you hold that short, the physical market is telling you that you are wrong, and the cost of being wrong compounds. What the CFTC data has been showing in recent reporting periods is that managed money, the hedge funds, the professional traders, have been reducing those short positions, not eliminating them, reducing them. That is significant because it tells you the smart money is not willing to fight the physical market indefinitely. Now here is where I want to be honest with you and give you the side of the story that the bullish channels are not telling you. The reason short interest can still exist at all, the reason this has not already forced a price spike, is that the paper market and the physical market can stay disconnected for longer than feels rational. I have watched this before. In 15 years in these markets, I have seen dislocations persist for weeks, sometimes months, before the convergence happens. The gap always closes eventually, but eventually is doing a lot of work in that sentence, and you should not treat it as a precise timing tool. If you know someone who has been watching silver this week and try and make sense of the moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Let me add the layer that makes this story genuinely global, because the East-West silver dynamic does not exist in isolation. China is not just buying silver as a financial asset. China is the world's largest manufacturer of solar panels. Silver is a core input in photovoltaic cells. The Silver Institute has documented consistently that solar demand for silver has been growing at a rate that the industry has not fully priced in. When I looked at the most recent Silver Institute demand data, industrial consumption is running at levels that were considered peak cycle numbers just a few years ago. And that demand is not price sensitive in the way financial demand is. A solar panel manufacturer does not decide to skip silver because the price went up 5%. They need the silver to make the panel. Full stop. The UK angle here is real and worth flagging for British viewers specifically. The UK government's offshore wind expansion targets, which are among the most ambitious in Europe, according to the Office for National Statistics Energy Data, require significant quantities of silver in electrical components and connectors used in offshore infrastructure. The Royal Mint has also reported elevated demand for silver coins and bars from UK retail investors, which mirrors the pattern we are seeing in the broader physical market. The industrial demand story and the financial demand story are pointing the same direction at the same time. That does not happen often. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, COMEX, futures, institutional positioning. What we are seeing there is front-month futures at $84.03, short interest declining as I mentioned, and a market that is being pulled upward by the physical reality, even as it tries to resist it. The paper lane is under pressure from below. Lane 2 is the physical market, and this is a lane doing all the heavy lifting right now. Shanghai at $88.25, a 6.5% premium. COMEX registered inventories under sustained pressure. Physical silver moving east through arbitrage. The physical lane is not just strong. It is arguably the driving force behind the entire setup. Lane 3 is the macro picture. Dollar elevated. Industrial demand from solar and AI hardware infrastructure running hot. Central bank diversification away from dollar assets, continuing as a structural trend per World Gold Council and IMF data. The macro lane is supported for silver even without the premium story. In 15 years watching currency and commodity markets, the times I've seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. What I am saying is that paper under pressure, Physical draining west to east and macro supportive. That combination is worth taking seriously. When the paper lane is losing the argument against the physical lane, and the macro lane is not providing the dollar strength that would normally crush the trade. History says convergence tends to happen faster than the skeptics expect. That is a framework, not a forecast. You decide what to do with it. If you have stayed with me this far, what is coming next is the part that actually tells you what to watch this weekend specifically. Here is the one thing I am personally watching this week. One thing, the Asia Open Sunday night, specifically where Shanghai silver prices on the first print after the weekend. If Shanghai opens Monday and the premium over COMEX widens beyond 6.5%, if that spread goes to 7% or beyond, that tells me the physical demand from the East has not abated over the weekend, and the pressure on Western registered inventory is going to intensify in the week ahead. Watch for COMEX registered silver inventory figures from the CME warehouse report published early in the trading week. If you see the premium widening and inventory falling in the same week, that is a combination that historically precedes a sharp convergence move. If the premium narrows toward 4% or below by midweek, that tells you the arbitrage trade is slowing. Metal is not moving east as aggressively, and immediate pressure on COMEX eases. That is a less dramatic but more stable outcome. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Physical delivery demands on COMEX need to intensify to the point where the registered inventory can no longer absorb them comfortably. If that happens, you get a forced convergence. COMEX prices spike toward the Shanghai level. The article flags $90 as the first target in that scenario. That is a roughly 8% move from current COMEX levels. It is not guaranteed. It is not imminent. But the mechanism that would produce it is real and documented. Now here is the honest, cautious picture. If broader financial markets face a sudden liquidity event, a sharp equity sell-off, a credit shock, anything that forces institutional players to raise cash quickly, silver gets sold regardless of the physical premium. This is what the article calls a sell-everything event, and it is a real risk. In that scenario, the premium compresses not because physical demand drops, but because paper silver gets liquidated hard and fast. The article flags $75 as a potential level in that outcome. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing. Is the premium widening or narrowing? Is COMEX inventory falling or stabilizing? Is broader market risk appetite holding or cracking? The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you seeing elevated premiums on physical silver at your local dealer or online right now? And has that changed your buying behavior? Second, looking at the three lanes, paper under pressure, physical draining east, macro supportive, do you think this premium closes because COMEX prices rise to meet Shanghai, or because Shanghai pulls back toward COMEX? Drop both answers below. I read every single one. Subscribe because next week we're going deeper into COMEX registered inventory data. I am going to show you exactly how to read the CME warehouse report yourself and what the current drawdown rate historically signals. That is a skill worth having. And if someone in your life is watching their silver stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.